Okay. We are going to look at 6.1, working together. This is journalizing entries to write off the uncollectible accounts using the direct write-off method. Okay, we'll do this a couple of different ways. And basically, uncollectible accounts are accounts that are accounts receivable that our customers aren't paying us. And we have to do some accounting to adjust for that and plan for that because it's going to happen. It's bad debt and it's going to happen. Maybe not every time, maybe not all the time, maybe not with the same customers every time, but it's just part of doing business. And so it's something, like I said, we have to adjust for and plan for. So we have a new account called uncollectible account expense. And another word for this might be bad debt expense. Just depending on what textbook, what people you're talking to. I know for UIL, they'll flip back and forth between those two. And then the other one is the uncollectible, well, that's all we need to know for this lesson, is the uncollectible account expense. And this is going to keep track of those accounts receivable that we're not getting. The direct write-off method is that we just wait. We wait until we know that they're not going to pay us. Okay, so we wait until we know that we won't collect on that account. Okay, and then we write it off as an expense. We take it off of the accounts receivable for that customer. Now, usually this is not allowed for GAAP because of the matching principle. Which means, if we wait for 3 months, then we're just way out of sync with our timeline. It could be from 1 year to the next. It could be 2 years later. And we're not making the adjustment for the accounts receivable in the correct fiscal period. We can use this if the amount is immaterial, means it's very small. Okay, so very small is okay. If it doesn't happen very often, and maybe it only happens, with a couple $100s or something like that, not thousands and thousands of dollars. Okay, so when we write off an account, we are going to use the expense account. So the expense account will be our debit. And so our uncollectible will increase. And our accounts receivable will decrease. And so we'll also have the accounts receivable for that company, whatever company that will be. Okay, so in our working together, our transaction is that we wrote off Loper Company's past due accounts as uncollectible for $115. So on February 3rd, that's not zooming in very well, is it? You may have to pause and get all that written down if you couldn't see that. I'm sorry. So on February 3rd, current year, we wrote off Loper Company for past due. So our debit's going to be the uncollectible account expense. and our credit will be accounts receivable / Loper Company. Okay, and this is one of those that's going to get posted twice, accounts receivable and Loper. And our documentation is memo 33. It's $115.81. Okay. And then on April 24th, we wrote off Polk Supply. So again, uncollectible account expense. Memo 42 for $95. And again, the AR for Polk Supply. And again, we'll post it twice, $95. Okay. So there is always a chance that somebody, I don't know, decides they're going to keep their business going and they've found some cash somewhere else, and so they come back and they pay all of their suppliers and their vendors. And so later on, Loper Company has decided that they're going to pay us. Now, we never told them that we wrote their account off. Okay, we still want to collect it. So if they come to us and say, "Oh, I want to pay my bill," you're going to go, "Okay, I'll let you pay your bill." You're not going to say, "Oh, we wrote that off," right? You're going to take their money because it's money they owe you. So basically, we just have to reverse this action and then collect the cash. So first thing that we're going to do on May 14th is, it says we received cash in full for Loper Company, the previously written off $115.81. This is memo 51 and receipt 221, because we're going to give them a receipt for giving us the cash. So we actually have two transactions going here. Okay, so when we collect, first off, we're going to reverse what we did. So our accounts receivable will go back up. We'll put that money back into the accounts receivable for the general and for the company. And we'll reduce the uncollectible expense. Okay, so that's just reversing what we did up here. Okay, then the second thing we'll do is we'll accept the cash. Okay, so then we'll take the cash in. So our cash will increase. Then the accounts receivable will decrease because they paid us the cash. Okay, so we're increasing it and then we're decreasing it right after that. But it's just got to happen that way because we've got to get our transactions corrected. Okay? All right, so on May 14th, we're going to first reverse our transaction. So now AR, Loper, will be debited for the $115. And the uncollectible accounts expense will be credited for the $115. Okay, again, we want to post that one twice. All right, so there's reversing it. Then we got to take our cash. So on the back side, you've got a cash receipts journal. Okay, so this is when we're collecting. So on May 14th, 115. Loper Company. And this is receipt 221. Our accounts receivable is going to be credited for the 115. And the cash, 115. Okay. Oh, I better get on my page numbers right. Page 4. I don't think I got my memo in here either. Memo 51. Okay. And this is page 2. Okay. So same thing again, June 8th. Receive cash in full payment of Polk Supply previously written off for the $95. So first we're going to reverse. Memo 64. Posting it twice for $95. Uncollectible accounts expense. $95. Then collect the cash. So we're on June 8th. Polk Supply. Receipt 259 for $95 and $95. Okay, so that is the direct write-off method. Again, making a note here, we still want to collect. So we don't tell the customers that we wrote them off. Okay, and bad debt, it's going to happen. Okay, so that's it for 6.1 using the direct write-off method. Okay, we'll do some other methods and other ways of doing this in the next couple of lessons.